The 2024 elections are finally coming to a close. Now, regardless of which presidential candidate won, I had planned to do a more in-depth breakdown of the tax proposals of that new president and what it might mean for retirement taxes. I think this is extremely important as potential changes in tax laws can have a big effect on your forward-looking tax plan, as well as things like your withdrawal and Roth conversion strategy. So in today's video, let's talk about how the Trump administration plans to affect your taxes. Now, in an attempt to be as fair and unbiased as possible in this video, I'm going to give a positive spin to each proposal alongside a negative spin. I think when we talk about any proposal, specifically related to taxes, it's difficult to label something as purely good because good for you and good for your neighbor could mean two different things. There are always secondary and tertiary consequences down the road that need to be factored in as well, and this can be extremely difficult as we need to make long-term projections. Take the example on the screen. Right now, individual income taxes are around 50% of the government's revenue. Say there was a hypothetical proposal to cut income taxes by 50%. On the surface, that's great. All workers and retirees are now able to keep more money in their pockets for consumption and saving for the future. Cutting taxes stimulates the economy, no doubt, at a minimum, at least in the short term. But there are two sides of this equation. What happens to spending? Say there are cuts to taxes, but no cuts to government spending. Is this still a good proposal? Most would say no. This proposal would just further the national debt and sure, would lead to some expected growth, but that growth is effectively had by borrowing from tomorrow. So as I go through this video today, again, I'm not going to label anything as good or bad, but rather talk about how it could be good or how it could be bad. Either way, we're going to give some insight on how it will affect you directly. Proposal number one, permanent extension of the Tax Cuts and Jobs Act. Tax Cuts and Jobs Act was put into law into 2018 by the first Trump administration and right now is set to expire in 2025 unless changes are made. Well, the biggest and arguably most likely proposal to pass is an indefinite extension of this tax law. Now, the reason I say this is the most likely proposal to pass, in my opinion, is because the Harris administration more or less was proposing the same extension, with the only difference being they would keep the 39.6% bracket for higher earners, and that bracket would kick in at lower levels. From a pure individual standpoint, this proposal will have a big impact for retirees. The clearest difference between these two tax regimes, the old regime and this regime, is that each tax bracket would rise by 0 to 4% should the Tax Cuts and Jobs Act sunset. But this isn't all. There are some minor adjustments in where each tax bracket would fall as well. For example, a married couple under the Tax Cuts and Jobs Act would have more room in the 24% bracket before turning into the 32% bracket. However, single filers will see different adjustments where the Tax Cuts and Jobs Act is better at certain levels, but actually worse at other levels. There is a large standard deduction with the current levels. And then there are also some big estate tax impacts should we revert back to the old brackets. Right now, the estate exemption, which is basically an estate standard deduction of sorts, is twice the level it would otherwise be if we revert back. Again, on an individual basis, really across the board, if you were someone who paid taxes, this law lowered taxes for each income group. So how could this be a negative then? Well, it could be a micro example of the hypothetical shown earlier. Tax cuts are generally great for your bottom line as an individual, but if government revenues are cut, and government spending isn't cut at least an equal pace, then annual deficits will simply grow, again, at least in the short term. If you're someone worried about the national debt, then larger annual deficits only compound the debt problem. Now, here's where we get into a little bit of a gray area projecting out economic models. If tax cuts stimulate the economy, grow GDP at a faster rate, then a nation can theoretically afford long-term to take a smaller cut of the pie because the pie has grown that much bigger. And this is really where you see economic projections really vary, where some think this will be the case, that tax cuts today will grow that pie. Others forecast that the stimulus from tax cuts won't do enough to stimulate the economy and grow the pie large enough. Proposal number two, eliminate income tax on Social Security. Right now, depending on how much other income you have, your Social Security will be taxed up to a maximum of 85% taxability. Once again, on the surface, this is a clear benefit for retirees. Should this be passed and it doesn't affect solvency, all retirement plans just became that much stronger. But at the end of the day, I find it hard to believe this will be passed. It's not something I would certainly build my retirement plan around. Let me explain how Social Security works to explain why. Right now, Social Security is funded from two sources. It's set up as a pay-as-you-go system, millions of workers pay payroll taxes from their paycheck specifically designated for Social Security and Medicare. These taxes immediately pay the benefits that current retirees are receiving. Any excess taxes that are greater than current benefits are put into something called the Social Security Trust Fund. Anytime taxes are less than current benefits, Social Security borrows from that trust fund to basically fulfill benefit obligations. Then once retirees receive those Social Security checks, a portion of those checks will be owed back into the greater system via taxation, and then a portion of those taxes are redistributed into the trust fund. So effectively, income taxes on Social Security go back into helping pay for Social Security. Now, to some, this seems like a little bit of a screwed up system. You pay taxes to earn a benefit, only to later owe taxes again from that benefit. It's a double taxation of sorts. And although true, this happens in most areas of life. You earn income from a job, which becomes a taxable event and leaves you with less. Then when you take that income and buy things, well, you are taxed again with sales tax, property tax, gas tax, and so on. I'm not saying this is right, just saying that it's not uncommon. But as we work through this flow chart of Social Security, we can see the problem with cutting those income taxes on benefits. As it stands right now, the Social Security Trust Fund is set to run out in the early 2030s. Should we see a cut in Social Security taxation, this date would only accelerate without some other offsetting mechanism. And this is the main issue with fixing Social Security really in any way. It's currently an unsustainable system, and to fix it, someone needs to feel the pain either in cutting benefits, raising taxes, or both. Cut benefits for retirees, and that's not fair because they paid in expecting a certain benefit. Raise taxes on the working public, and that's not exactly fair either because now we have a working population that will have to pay in more to effectively get the same benefit they were expecting before. My main point here, although this would be great for retirees, there is more that needs to be addressed here. Number 3, right now there's a proposal to eliminate income tax on tips and overtime work. This will be a shorter point overall. Again, on the surface, this no doubt benefits workers and retirees who work a job that is tip heavy. That generally tends to be lower income jobs and is an area that both parties express interest in helping. Making overtime work tax-free, although not necessarily helpful to retirees, is certainly helpful for those saving for retirement. I think the main critique one could loft at this proposal is why make certain income preferable to others. Taxes can be used as a tool to incentivize or disincentivize activities. The reason capital gains taxes are more preferred than ordinary income tax is because it's beneficial for an economy to incentivize investment. There's a reason tobacco products have an excise tax. The government is effectively trying to disincentivize an activity. Assume two people make the same, one working at a restaurant with a tip-heavy job, the other is a construction worker. Given the same level of income and let's say the same overall financial status, why provide a benefit to one worker versus the other just based on the type of income they receive? Number 4, right now approximately 90% of tax filers simply take the standard deduction because number 1, it's large, and number 2, certain itemized deductions are capped, thus making a standard deduction often greater. One that is currently capped is the SALT deduction, which is an allowable deduction for state and local taxes. As the law stands today, it's currently capped at $10,000, but one proposal talks about eliminating this cap. For retirees that live in higher cost counties and states, lifting the $10,000 cap could certainly be meaningful. In some of the most expensive counties in America, the average SALT reported per tax filer in that county can be as high as twice the current cap. For those tax filers, this can be a big deal. But remember, you still need to itemize deductions and have that be greater than the standard deduction to gain any benefit. So if itemizing deductions are only $1,000 over the standard deduction, then the benefit of being able to deduct uncapped SALT is relatively small. There's also talk of adding in an auto loan interest deduction. As you can see from data AAA broke out, assuming someone gains a benefit from itemizing, any benefit from this deduction would be quite small. The main critique one would loft at this proposal is they mostly benefit higher earners and wealthier retirees. Based on your political philosophy, that could be a great thing or that could be problematic. Then the last proposal I want to address is tax proposals around tariffs. Now, I won't specifically discuss whether Trump's tariff strategy is wise or not, as that's going to get a little bit more into economic policy than tax policy. But there is one proposal that intertwines both. An idea has been thrown around to eliminate income tax altogether in favor of tariffs. The idea being that revenue generated from tariffs would offset lost revenue on no income taxes. This could be a pretty compelling proposal if possible, but unfortunately, the math here doesn't really math. Goods imported pales in comparison to the adjusted gross revenue base. Not only that, the larger tariffs you place, the less imported goods one has. As it currently stands, I don't see a way this is a realistic proposal. Now, maybe if there was a situation where a portion of tariff taxes offset a portion of income taxes, I could see the through line to something like that. But I certainly wouldn't build your retirement plan around assuming that income taxes are going to go away and tariffs are going to completely replace those income taxes. So now let's hit on two major items that weren't in current Trump administration proposals that really matter to retirees. And I'm not saying that they should have been in proposal for these two items, just noting that these are important topics for retirees. And again, there were no changes planned in these categories. Right now, as part of the Inflation Reduction Act, healthcare subsidies for Affordable Care Act insurance are much more forgiving. You can report over 6 figures of income and still earn a subsidy, which in turn lowers your healthcare costs. As it stands right now in 2026, we are set to revert back to the old subsidy cliff system. This is an area where if a married couple currently earns more than approximately $80,000 or so dollars, you would fall off the subsidy cliff and earn no subsidy. As it stands right now, this timeline is still in place. There are also no proposed changes to capital gains. I bring both of these topics up because the Harris administration planned to target both of these areas in a meaningful way. Again, I'm not saying that's right or wrong, just noting this. Now, with all of this talk around tax proposals, how should you think about building these changes or potential changes into your retirement plan? Generally speaking, here at Safeguard, we really believe in planning based on the rules that we know today. I don't like trying to predict what politicians are going to do now or 10 years in the future. That being said, I think one proposal that is worth putting a bit more weight on is the extension of the Tax Cuts and Jobs Act. The main reason is that it's already current law, and most politicians don't want to be labeled as someone who raised taxes. Now, I wouldn't necessarily build your plan assuming 100% the Tax Cuts and Jobs Act will be extended, but it's worth running an analysis in both scenarios and seeing how your optimal tax strategy changes. In addition, know that this is not all up to the Trump administration. Most tax changes need to be approved by Congress as well as the president. So any proposal shown here will likely be met with some offsetting variable. For instance, if some law does pass that would make Social Security non-taxable, it's very likely, in my personal opinion, there would be an offsetting mechanism that would raise revenues or pay for Social Security in another way. Then, if you're someone that hated every proposal discussed here, the silver lining is a lot of these proposals never make it into law. I have a snapshot of tax proposals from the last 2 elections, and as you can see, most never came to fruition. So again, take these proposals with a grain of salt overall. I think some should be taken more seriously than others, but again, take them with a grain of salt. I hope you enjoyed this video and would love to hear comments down below if you see certain tax proposals differently. If you're someone who is looking to make sure their tax strategy makes sense regardless of the environment we find ourselves in, click here to learn why the account you pull from first in retirement really won't change based on any tax proposals currently being discussed. Click here to learn more about building a strong withdrawal strategy. Thanks so much for watching, and always remember, you don't need more money, you need a better plan. Look forward to seeing you in the next video.